Hey everyone, Anthony Venuti with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in. On this episode, we're going to talk about the Bank of Canada. When will they stop increasing these interest rates and what you should be prepared for? Stay tuned, you don't want to miss this. When will the Bank of Canada stop raising interest rates? What are they trying to do to the economy and to the housing market? These are the questions that we're getting asked here at In Touch Mortgage Solutions, not only by our clients and our viewers, but basically anytime we go out as mortgage professionals in the industry. Now, obviously, I want to do my best to try and tackle this question as best as humanly possible, as we don't have a crystal ball. But what I want to do by the end of this video is give you some insight on why and what we are thinking here at In Touch Mortgage Solutions when it comes to the Bank of Canada. But in order to get to where we're going, I think it's important to take a little step back and look at where we've been. And obviously over the last 6 months, we have seen some major movement by the Bank of Canada in a strong effort to continuously tackle inflation. On September 7th, the Bank of Canada increased an additional 75 basis points, which has now brought the overnight policy rate to 3.25%. And that will translate to, through most lenders, most top tier banks, as well as your mono and broker friendly banks, increasing their prime rate to 5.45%. Now, obviously, these changes will impact many different mortgage holders, as well as would-be buyers, consumers that are looking to get into the market. If you have a variable rate mortgage, one that is on an adjustable payment, that is where your payments change with the Bank of Canada, you will notice that your payments will change on either your mortgage, your home equity line of credit, any types of loans or credit cards that are based on that prime lending rate. So that's important to understand. As well as for clients that have that static payment with that trigger rate, most likely a lot of Canadians who have originated their mortgages between March of 2020 and March of 2022 might be actually triggered at this current point with that additional 75 basis points. We can't be 100% certain because it all depends on if you've increased your payments accordingly, what the payment frequency of your mortgage is, if you've contributed lump sum payments to that mortgage, and also dependent on the amortization. The best way to get some information about that is to reach out to your lender directly. So what I have done is created a little chart to basically illustrate what has happened over the last little while. Now, looking at the chart, you'll notice there's a different columns. So obviously the Bank of Canada increased dates. We have the increase from the prime of 0.25% from the effective lower bound. And then obviously what that translated to into prime rates with most banks, as well as what variable rate mortgage holders with an adjustable payment can or have anticipated over the last 6 months. So you'll see on March 2nd, 2022 was the first increase by the Bank of Canada. They did basically miss the mark on that. They should have started much sooner. However, and they increased 25 basis point, bringing prime from 2.45% to 2.7%, which translated into an average of about $12.92 per $100,000. So we're using, basically for information purposes only, $100,000 on a 30-year amortizations, just for illustration, to give clients an idea of how much their payments have changed. On April 13, 2022, we saw an increase of 50 basis points, bringing prime to 3.20%, and basically an additional $26.51 were added to those monthly payments per 100,000. On June 1st, we saw an additional 50 basis points, bringing that prime lending rate up to 3.70% and an additional $27.38. And then on July 13th, we had a mammoth increase of 1%, basically bringing prime from 3.7 to 4.7%, and an additional $57.22 were added. And then obviously the one that just happened on Wednesday, September 7th, 0.75, bringing prime to 5.45%, an additional $44.94, total policy rate at 3.25%. And what you'll see over in the change per $100,000 column is $168.97 estimated per 100,000. So obviously we understand that a lot of clients on variable rate mortgages are feeling the pain, and a little foreshadowing, I don't think that pain's going to end anytime soon. We are definitely open for some additional rate hikes, one on October on the 26th and then an additional one on December 7th, in my professional opinion. And I'll get into the reasons why I believe that is to be true. Basically, you have to understand that yes, your payments are going to go up. payments will change based on the prime lending rate and understanding your budget. A lot of the conversations that we're having with clients who are approaching us with these difficulties or might be facing some challenges when it comes to their mortgage financing and making those payments is understanding what they have as a budget, and you have to conduct one for your personal and your household to make sure that you are able to see exactly where your payments are headed. You can download the app in the description box below to see exactly what your payments may or may not look like depending on potential rate increases and how you can better prepare yourself for those changes that could be coming down the pipeline. Now, it's very important to understand that not only are variable rate mortgage holders obviously impacted by this additional 75 basis point increase, but potentially consumers that are coming up for renewal, people that are looking to go out there and purchase, a lot of clients that were on the sidelines, like a lot of first-time home buyers and millennial buyers. Back in January, February, March, we had a whole bunch of active pre-approvals. A lot of those went into hibernation. We're starting to see a slight uptick in consumers looking to get back into the market, especially with a lot of the deep discounts on real estate right now, especially as those prices are continuously falling. Even though interest rates are relatively higher than they were a few short months ago, basically these clients are looking at the advantage of saying, hey, we believe that interest rates are probably going to go up a little bit, maybe stay a little bit level, but we're willing to take the deep discount on those real estate purchases in order to get into the market at a comfortable point. Now remember, we're not forcing people to get out into the market. These are clients that are reaching back out to us, making that decision. We're having those conversations. We're going through those risk questions. We're asking them what their ability and their appetite for risk when choosing a fixed and a variable. These are very important conversations in this marketplace, and understanding your financing needs is very important. It's not always about the rate, it's about the product and understanding what that product will allow you to do. So we're not going to sit here and talk generally about, what is better, what is best. It's obviously what is best for you and your family. Now, in addition to obviously the pre-approvals that may be active, you have to look at that, especially if you're on a variable rate pre-approval. As the policy rate did increase, that could push some pre-approval holders out of the price point, not only out of qualification because of that additional 75. When that actual deal goes live, remember it's a pre-approval. You are getting a hold on the discount portion of the variable rate. You're not getting the locked in for the policy until the deal is live and submitted and reviewed with that particular property. And that applies for even clients that have pre-construction closings that are coming up, condos or homes. A lot of them are being pushed out of that window of that 120 days. And if they were approved on a variable rate mortgage because it was easier to qualify, then they have to be very cautious moving forward. And speaking of qualifying, right now, obviously, this is going to make a major change to clients' qualifications when applying for a pre-approval. And I'll illustrate this with just basic, some simple math. If we look at a variable rate right now, let's say prime, which has moved up to 5.45%, let's say you're getting a discount of 45 basis points for simplicity. That means your rate is now 5%. The rule is we have to qualify you plus 2 of the contract rate. So 5 plus 2, 7%. Now fixed rates have been hovering generally around the high 4s, low 5s. So basically if we use, let's say 5.25% as a rate for a fixed rate mortgage plus 2%, you're qualifying at 7.25%. As you can see, the gap between the fixed and the variable are very close together. I basically created a little chart here. You'll see that basically I used a client who's, let's say, making a combined household income of around $150,000. This is just for illustration. Let's say they have a condo fee of $350 and some property taxes attached to this condo. We used basically, the criteria with no debt to illustrate the fact that there is a significant amount of difference between what they would qualify for prior to September 7th and what they will qualify for after September 7th. And I used basically the qualifying rate of 6.7% when prime was at 4.7 plus, the additional 75, and now it's 7.45% with the additional 75 added in, and you can see it's about a $48,891 difference in purchasing power. So you're basically getting truncated $50,000 in the ability for you to go out there and buy. Now, obviously, as I alluded to at the beginning of the video, I wanted to discuss my mindset on why I believe that the Bank of Canada will continuously try to tackle inflation, and we will see future increases both in October and December. Now, I'm not going to say that they're going to happen in both months. Maybe we're going to see an additional one in October or maybe one in December, but we can at least bet on for sure at a bare minimum of a 50 basis point increase. I think we'll end off the year probably around 3.5 to 3.75% as a Bank of Canada policy rate. Now, just to keep in mind, the policy rate right now is above the neutral range, or is in that neutral range, almost in restrictive territories, depending on what information you're consuming. But basically, this is very problematic, and the Bank of Canada indicating that they're okay to bring that policy rate up and beyond the restrictive area, meaning that they will allow the economy to basically suffer. And with all the wage spiral concerns, all the issues with foreign, Ukraine and Russia, all the issues with farming and supply chains, all these things are still really relevant to where the Bank of Canada is headed. But the fact that we heard from Jerome Powell from the U.S. Federal Reserve, and we're basically getting indication that in Europe they're going to be increasing interest rates, and they're basically looking at the economy and saying, hey, that is a side effect right now. We need to increase our policy rates to tackle inflation, to make sure that we don't see what happened in the 70s and the 80s again. They want to get ahead of it. They're front loading those rates in order to tackle inflation. So remember, when they increase these interest rates, it's basically a projection to make sure that inflation comes back down. It can take months for these actual inflationary numbers to actually peak. Now, Anthony, what are you talking about? On July, it went down to 7.61%, and we were at 8.1% inflationary numbers. However, in the previous video, we talked about the core inflationary numbers with gas prices are still elevated and very high, and still a concern for the Bank of Canada. But the biggest factor that I feel from listening to them talk and listening to those press conferences, listening to what's happening in the US, and the fact that both heads of the central banks, and the most important one being the US, basically saying that we are okay with the economy sort of going into a little bit of a slump in order for us to tackle inflation, means that we are potentially going to see that. And obviously the markets are spooked, but what I will do is lean on the Bank of Canada, the US Federal Reserve, on what their objectives are. And their objectives are to basically put a lid on inflation. And when they tell me we're willing to let the economy and GDP suffer in order to do that, that means they are full steam ahead with potential increases in October and December. And you as a consumer, whether you have a variable rate mortgage or a fixed rate mortgage, if you're coming up for renewal, you need to take advantage, do your budgeting, do your calculations, reach out to your mortgage professionals, and find out exactly what you can do to better prepare yourself for additional increases. Now, whether that means locking into a fixed rate mortgage or increasing your payments on your variable to make sure that your amortization stays on track, it is entirely up to you. But as I said, we do need to address the fact that I believe, and if I had to bet, we will definitely be seeing some increases in October and December. And I think that is probably where we're going to end the video off now. Once again, we want to thank everyone for watching, for all your feedback. If you like the content that we're producing here at In Touch Mortgage Solutions on our Finance Fridays videos, please feel free to hit that share, like, and subscribe button and that notification bell. And if you know someone that could benefit from the content that we do, please don't forget to share our videos with them as well. But we'll leave it there. Have a great weekend, have a great Friday, and thank you again for watching.